With all this talk of money, 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 you're probably wondering how you're going to finance it all. Don't be concerned. It costs a lot of money to start a trucking firm, but financiers appreciate the risk and believe it will pay off in the end. That is why, in 2020, they are providing some fantastic funding options for transportation enterprises. Let's have a look at some options. Equipment financing. With vehicles costing up to $150,000, you'll almost probably want financial support to get started. Equipment financing may enable you to purchase everything from truck cabins to beds to coffee machines and even computer software. There is no better way to fund your large rig fleet than with a loan of up to $5 million over 5 years. Term loan. A term loan may be utilized to support nearly any area of your business. You'll be given a lump sum of money with clearly defined rates and terms, so you'll know exactly how much you'll have to pay each month. Short-term loan. A short-term loan may be the best option if you need money straight now. You'll have to pay a higher interest rate, but your money will be available in as little as 24 hours. SBA's loan. Because the trucking industry is critical to the United States, the government provides several low-interest loans. Qualifying for an SBA loan is challenging, and the process is time-consuming and exhausting, but if you do, it's an excellent financing choice. Factoring. Invoice factoring is a method for businesses to get cash into their accounts by selling their invoices at a discount to a third party. Companies receive instant compensation for outstanding bills that are due within 90 days, rather than having to wait for their customers to satisfy their financial commitments. This funding option is ideal for companies who want fast funds to pay invoices or make major purchases, such as inventory. Because costs may be significant if clients wait more than 30 days to pay their bills, factoring is best used as a short-term finance alternative. Is invoice factoring worth it? Invoice factoring is best employed when a company needs cash to cover inventory purchases or payroll and has invoices from customers with good credit that are due in fewer than 90 days. The company may convert those invoices into instant cash to help them run their business. If you have solid credit, a low debt-to-income ratio, and don't need the cash within a week, factoring may not make sense. A long-term business loan or line of credit would be a better choice in this scenario, since the effective interest rate would be significantly lower. Difference between invoice financing and factoring. Both invoice financing and invoice factoring give capital to a firm in need of cash to meet its objectives, such as completing payroll, paying vendors, or purchasing more goods. They do, however, disagree on one critical aspect. Invoice factoring is a sale, whereas invoice financing is a loan. A company that employs invoice financing obtains a loan from a bank based on the value of its outstanding invoices. You'll have to make payments just like any other loan, and your company will continue to receive payments from clients as usual. Invoice factoring happens when a firm sells its invoices at a discount to a factoring company in return for quick cash. The invoices are then owned by the factoring business, which receives payment from your clients.